The last 3 times the gap between the cost of overnight funding and the return on equity reached critical extremes. The subsequent unwinding destroyed not just portfolios, but the plumbing of the global financial system. In October 1929, that gap didn't just widen, it snapped. While history remembers the screaming traders and the shattered windows, the real signal had flashed weeks earlier in the quiet, boring ledgers of the call money market. By analyzing these structural breakpoints here on Finance Saga, we move beyond the fear of the past to understand the mechanics of the present. The 1929 crash was not a random psychological event where people suddenly lost faith. It was a mathematical inevitability caused by a specific leverage machine running out of fuel. To see why the elevator operator at the Equitable Building noticed his passengers trembling on that Thursday morning, you have to look past the emotional narrative of broken dreams and look directly at the loan book. It was October 24th, 1929. The source script describes this moment as the day America realized it had been living a lie. But in financial terms, the market had simply hit the hard ceiling of a liquidity constraint. For 5 years, the U.S. economy had been running a massive carry trade. Factories were efficient, electrification was spreading, and corporate profits were high. But the explosion in stock prices, the Dow Jones tripling in 5 years, wasn't funded by savings. It was funded by the call money market. In the 1920s, the call loan was the functional equivalent of today's repo market or margin debt. It was a loan that could be recalled by the lender at any moment, on the call. An investor would put down 10% of the cash to buy a stock, borrowing the other 90% from their broker. The broker, in turn, borrowed that money from a bank. As long as the stock price rose faster than the interest rate on the loan, the machine printed free money. But this system created a dangerous dependency that most historians overlook. It meant the entire stock market was sensitive not just to corporate earnings, but to the availability of overnight cash. This brings us to the primary mechanism map that we will use to diagnose this collapse, a framework that explains almost every liquidity crisis in the last century. Visualize a flow moving from left to right. Funding source leads to intermediary, which leads to macro outcome. In the 1929 iteration of this map, the funding source was not just the Federal Reserve, it was unregulated corporate cash. The intermediary was the call loan market. The macro outcome was asset price hyperinflation. Here is why that specific mechanism matters today. By 1928, the Federal Reserve, led by men who feared speculation, tried to shut down the party. They raised interest rates to 5% and 6%, trying to make borrowing too expensive for speculators. In a normal system, this would have cooled the market. But the 1920s financial system had mutated. When the Fed pulled back, a shadow banking system emerged to fill the void. Major industrial corporations, Standard Oil, Chrysler, Bethlehem Steel, found that they had so much excess cash on their balance sheets that they could make more money lending it to stock gamblers at 12% interest than they could by building new factories. This was the bootleg loans market. It was massive, unregulated, and completely outside the control of the central bank. By October 1929, nearly half of all the money fueling the stock market came from these private corporations, not banks. This creates a terrifying instability in our mechanism map. If the funding source is a bank, the Fed can support it during a crisis. But if the funding source is a car company or an oil giant, and they suddenly get scared and want their cash back, there is no backstop. The liquidity simply evaporates. So when the sun rose on October 24th, the chaos described in historical accounts was actually a rational scramble for collateral. The mechanism had reversed. Prices began to slip, perhaps due to a tariff vote or a weak earnings report. But the trigger didn't matter. What mattered was the leverage ratio. As prices dipped, the 10% equity buffer that investors held was wiped out. Brokers issued margin calls, demanding immediate cash. But the investors didn't have cash. They only had stocks, so they had to sell stocks to raise cash. This selling drove prices down further, triggering more margin calls, which forced more selling. The source text paints a picture of a breakdown in trust, noting that trust held the entire system together. That is poetically true but technically imprecise. What held the system together was the ability to rehypothecate assets, to use one share of stock to secure a loan, which was used to buy another share. When the call money rate spiked to 20% during the panic, it signaled that cash was becoming more valuable than the assets it purchased. The shadow lenders, those corporations who had been happily earning 12%, saw the volatility and panicked. They didn't just stop lending, they recalled billions of dollars in loans overnight. This is the sudden stop dynamic. The elevator operator saw millionaires crying not because they were sad, but because they were insolvent. The ticker tape fell hours behind, not just because of volume, but because the velocity of liquidation exceeded the physical capacity of the infrastructure. Traders were flying blind, executing orders at prices that no longer existed. This wasn't a market discovering price. It was a market discovering the absence of liquidity. Contrast this with the popular image of the Roaring Twenties as a time of boundless optimism. It was actually a time of extreme financial engineering. The wealth that evaporated wasn't just paper profits, it was the collateral base of the banking system. When a stock dropped from $100 to $50, the loan secured by that stock became toxic. The lender, whether a bank or a corporation, was suddenly holding bad debt. This explains why the contagion moved so fast. It wasn't just that people felt poorer, it was that the balance sheets of the lenders were mathematically broken. In the days leading up to Black Thursday, the smart money had already engaged in what we call distribution. They were selling their positions to the retail public, the barber, the grandmother, the shoeshine boy, who were entering the market right at the top, funded by that expensive 12% debt. The retail public was holding the bag, but the institutional lenders were holding the risk. When the correction started, the mechanism map turned red. The flow of funds reversed. Instead of cash flowing to stocks, stocks were liquidated to flee back to cash. This distinction is vital. A price crash hurts investors, but a funding crash destroys economies. 1929 was a funding crash. The withdrawal of non-bank lenders created a vacuum that sucked the oxygen out of the entire American economy. And as we will see, the attempt by the banking elite to plug this hole was doomed to fail because they were trying to fix a solvency problem with a temporary liquidity patch. By noon, on Black Thursday, the New York Stock Exchange had ceased to function as a market and had become a slaughterhouse for collateral. The source narrative describes the cruel mathematics of panic, but the specific equation driving the collapse was the forced liquidation of basis. When a market functions normally, there are buyers and sellers negotiating value based on future expectations. But on October 24th, the sellers weren't selling because they wanted to. They were selling because the terms of their loan contracts mandated it. This is a critical distinction in financial history. A distressed sale. Price does not reflect the value of the company. It reflects the desperation of the seller to obtain cash. Richard Whitney, the vice president of the exchange, provided the day's most cinematic moment, but it is often misunderstood. At 1:30 p.m., Whitney walked onto the floor, marched to the post for U.S. Steel, and loudly placed an order to buy 10,000 shares at 215, significantly above the current trading price. The room cheered. The panic briefly subsided. History books frame this as a heroic act of confidence, a general's planning a final stand moment. However, if we look at the balance sheets of the consortium he represented, J.P. Morgan, Chase, National City Bank, we see the real motivation. These banks weren't trying to save the retail investor. They were trying to defend the value of the collateral sitting in their own vaults. If U.S. Steel fell below a certain threshold, the loans these banks held would be underwater. Whitney's bid was not optimism. It was a calculated attempt to manipulate the spot price of collateral to prevent a banking solvency crisis. This intervention brings us to our first historical comparison, Case B, the Panic of 1907. 22 years earlier, the elder J.P. Morgan had faced a similar liquidity freeze. He famously locked the city's leading bankers in his library and forced them to pool their capital to bail out the trust companies. It worked. The panic stopped because the liquidity injection was large enough to overwhelm the selling pressure. In 1907, the money power was concentrated enough that a few men in a room could essentially print confidence. But Case A, the 1929 crash, revealed a terrifying evolution in the market structure. When Whitney made his bid on Thursday, it worked for exactly one afternoon. Why did it fail by Monday? Because unlike in 1907, the leverage wasn't concentrated in a few trust companies. It was dispersed across millions of retail accounts and fueled by those bootleg loans from industrial corporations. When the panic resumed on Monday and Tuesday, the volume of selling wasn't coming from institutions that could be bullied by bankers. It was coming from thousands of automated margin calls that no amount of capital could absorb. The shadow liquidity provided by the corporations evaporated instantly. Standard Oil didn't care about J.P. Morgan's library, they just wanted their cash back. This failure highlights the second iteration of our mechanism map. Funding source, shadow lenders recall cash. Intermediary, brokers trigger auto-liquidation. Macro outcome, asset price spiral. In this phase, the feedback loop became self-reinforcing. As prices fell, the value of the collateral fell. This triggered a haircut on the loans, meaning lenders demanded even more collateral for the same loan amount. This flushed more supply onto a market with zero demand. The ticker tape delay, which ran 4 hours late on Tuesday, exacerbated this by destroying price discovery. A broker might see a stock trading at $150 on the tape, but when he tried to execute a sell order, the floor price was actually $110. The air pocket between perception and reality is where the fortunes were lost. The carnage of Black Tuesday, October 29th, was the final snapping of the chain. The source text mentions 3 million shares trading in 30 minutes, a volume that physically overwhelmed the human capacity to record it. But consider the counterparty risk. As the market crashed, it wasn't just that stocks were worth less, it was that the brokers who had facilitated the trades were going bankrupt. If you had sold your stock at a profit earlier in the day, but your broker collapsed before settling the trade, you were still wiped out. This is the counterparty chain dissolving. The trust that held the system together wasn't abstract moral trust. It was the specific expectation that the clearinghouse would honor the trade. We can quantify the devastation through the if-then logic of the era. The unwritten rule was, if the call money rate stays above 10% for more than a month, then the equity risk premium must adjust violently. In 1929, that adjustment didn't happen gradually. It happened all at once. The smart money that had exited early, men like Jesse Livermore who shorted the market, understood that once the credit cycle turned, gravity would take over. Livermore didn't bet on a depression. He bet on the mechanics of a margin call. He knew that forced sellers are price insensitive. They don't sell at a target price, they sell at any price. The aftermath of Tuesday changed the narrative from a financial correction to an economic disaster. The banks, having failed to stop the crash with Whitney's theater, retreated to save themselves. They stopped lending entirely. This is the moment the crisis jumped from Wall Street to Main Street. In the 1920s, companies relied on rolling over short-term debt to pay for payroll and inventory. When the stock market crashed, the banks, terrified of their own losses, froze all commercial lending. A perfectly healthy factory in Ohio, with a full order book, could suddenly no longer make payroll because its credit line was cut. The tragedy of 1929 is often framed as a moral reckoning for greed, but a financial history lens shows it was a structural failure of market plumbing. The liquidity provided by non-bank actors, the corporations, was fair-weather liquidity. It was there when times were good and vanished, the second volatility spiked. This left the regulated banking system holding a bag it was too small to carry. The 40% drop in the market over those few weeks wiped out $30 billion in wealth, more than the cost of World War I. But the real cost was the destruction of the credit mechanism itself. As the dust settled on that terrible Tuesday, the mechanism map had reached its final, most destructive stage. The intermediary, the financial system, had ceased to transmit capital. Money was hoarded, not circulated. The velocity of money collapsed. And here lies the most dangerous misunderstanding of the crash. People assume the depression started because the stock market fell. In reality, the depression started because the response to the crash was to tighten conditions rather than flood the system with liquidity. The policymakers looked at the broken machine and, instead of adding oil, they decided to drain the fuel tank. The tragedy of the Great Depression is not that the stock market crashed. It is that the crash was allowed to metastasize into a collapse of the real economy due to a fundamental misunderstanding of how credit works. In the months following October 1929, the Federal Reserve and the Treasury Department committed what is likely the single greatest policy error in financial history. They viewed the collapse not as a liquidity crisis that needed patching, but as a moral cleansing that needed to finish its work. Treasury Secretary Andrew Mellon famously advised President Hoover to liquidate labor, liquidate stocks, liquidate farmers, liquidate real estate. His logic was that high prices were artificial and that the system needed to purge the rottenness out of the economy. This ideology, known as the real bills doctrine, held that the central bank should only lend against real commercial activity, not speculative assets. So, when the shadow lenders, those corporations and private trusts, fled the market, the Fed refused to step in. They let the money supply contract by nearly 30% between 1929 and 1933. This brings us to the specific mechanism that turned a recession into a depression. Debt deflation. As prices fell, the real value of debt rose. If a farmer owed $1,000 and wheat dropped from $1 to $0.50, he effectively had to grow twice as much wheat to pay the same debt. Everyone tried to pay down debt simultaneously by selling assets, but this collective selling only drove prices lower, making the remaining debt even heavier. It was a paradox where the more the economy paid, the more it owed. To understand how avoidable this was, we only need to look at our counterexample. Black Monday, October 19, 1987. On that day, the S&P 500 crashed 22.6% in a single session, nearly double the drop of 1929, Black Thursday. The structural trigger was eerily similar. Portfolio insurance, a computerized selling strategy, acted just like the margin calls of 1929, creating a feedback loop of forced selling. But the outcome was radically different. There was no Great Depression in 1988. Why? Because the Federal Reserve, now led by Alan Greenspan, understood the mechanism map. Before the markets opened on Tuesday, October 20, 1987, Greenspan issued a single sentence that changed the course of financial history. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. He didn't wait for the rottenness to purge. He flooded the system with cash, practically forcing banks to lend to brokerage firms. The Fed broke the mechanism of 1929 by changing the first variable. The new map read: funding source, Fed money printer; intermediary, banks incentivized to lend; macro outcome, asset stabilization. The link between the stock market crash and the real economy was severed. However, this cure has created its own disease, bringing us to the fragile state of the present day. By guaranteeing that the central bank will always backstop liquidity, we have encouraged the financial sector to rebuild the leverage machine of 1929, but on a much larger and more opaque scale. We are no longer dealing with simple stock margin. We are dealing with systemic basis trades and shadow leverage that dwarf the bootleg loans of the Roaring Twenties. This brings us to the three signals now, three concrete metrics flashing red in 2024 that mirror the pre-crash architecture of 1929. The first signal is the yield curve slope, specifically the 10-year minus the 3-month Treasury yield. In a healthy economy, long-term debt pays more than short-term debt. When this relationship inverts, when short-term rates are higher, it signals that the funding markets are broken. As of late 2024, this curve has been inverted for the longest consecutive period in history, surpassing the warning signal of 1929. It tells us that the cost of holding a position, funding, is higher than the return on the safe asset, carry, a mathematical anomaly that eventually forces liquidation. The second signal is the hedge fund Treasury Basis Trade. This is the modern spiritual successor to the 1929 call money market. Hedge funds today are shorting Treasury futures and buying the underlying bonds, pocketing a tiny price difference. To make this profitable, they use massive leverage, often borrowing 50 to 80 times their equity in the repo market. The Bank for International Settlements, BIS, estimates this shadow position is over $1 trillion. Just like the margin debt of 1929, this trade assumes that overnight funding will always be cheap and available. If the repo rate spikes, as it did in September 2019, this trade unwinds violently, forcing the sale of the world's most important collateral, U.S. Treasuries. We are seeing leverage ratios in this sector that rival the margin accounts of the 1920s. The third signal is unrealized losses on bank balance sheets. In 1929, banks failed because their stock collateral collapsed. And today, banks are sitting on hundreds of billions of dollars in unrealized losses on government bonds and commercial real estate. The signal here is the Bank Term Funding Program usage and emergency borrowing windows. When banks are borrowing against their held-to-maturity assets just to stay liquid, they are effectively in the same position as the rural banks of 1929, insolvent on a mark-to-market basis, but kept alive by regulatory forbearance. The danger today is not a simple repetition of history, but a rhyming of the mechanism. In 1929, the leverage was in equities. Today, it is in the funding of government debt itself. The mechanism map has evolved. Funding source, repo market; intermediary, hedge fund basis trade; macro outcome, treasury market volatility. If the funding source dries up, the intermediary cannot hold the position. But unlike 1929, where the liquidation crushed stock prices, a liquidation today would crush the bond market, driving interest rates vertically higher, and freezing the credit that every government, corporation, and homeowner relies on. This precarious setup leads to the most critical question for any investor or observer today. At what point does the tension snap? We know the signals are flashing, and we know the Fed has the 1987 playbook, but we also know that inflation constraints might prevent them from using it. If the Fed is forced to choose between fighting inflation, tightening liquidity, and saving the bond market, loosing liquidity, they face the exact dilemma that paralyzed the central bank in 1929. The most dangerous illusion in finance is the belief that wealth stored in financial assets is the same as money in the bank. When the leverage machine breaks, as it did in 1929, and threatens to do today, the hierarchy of capital asserts itself with brutal efficiency, separating those who own the asset from those who merely own the claim on the asset. Understanding who pays and who benefits in a liquidity crisis requires stripping away moral judgments about greed or fairness and looking strictly at cash flows. In the deflationary collapse of 1929, the winners were a tiny minority, those who held zero-duration currency, literal cash or gold, and those who held senior debt in surviving institutions. By holding cash while prices fell 30%, their purchasing power effectively increased by 43%. They didn't need to grow their wealth. The deflation grew it for them. The losers were not just the speculators, but anyone who held illiquid assets financed by short-term debt. The farmer with a mortgage, the factory owner with a credit line, and the investor on margin all faced the same problem. Their liabilities were fixed in nominal dollars, but their assets were repricing in real time. However, the calculus has shifted in the modern era. In 1929, the currency was hard, gold-backed, so cash was the ultimate refuge. Today, with a fiat currency system managed by a central bank committed to preventing deflation, holding cash carries its own risk, inflation. If the Federal Reserve responds to a crash by printing trillions, as they did in 2020, the winner is not the cash holder, but the owner of unencumbered hard assets, commodities, prime real estate, or productive businesses with no debt. The loser in the next crisis will likely be the holder of long-duration government bonds, who gets paid back in devalued currency. The mechanism of pain has migrated from the stock market to the bond market. To navigate this landscape without succumbing to fear, we apply our quantified if-then funnel. This is not a prediction, but a decision tree based on historical thresholds. The base case, 60% probability, the cyclical reset. If the unemployment rate rises 0.5% above its 12-month low, triggering the SARM rule, and high-yield credit spreads widen beyond 500 basis points, then we are in a standard recessionary deleveraging. Historically, this results in a 20–30% equity drawdown and a 6 to 9 month contraction. The mechanism is a slow, grinding halt to corporate earnings, not a sudden snap. The crisis case, 20% probability. The 1929 liquidity break. If the repo rate spikes significantly above the Fed funds rate, indicating a breakage in the basis trade, or the Treasury market liquidity index collapses to 2020 lows, then we face a systemic, sudden stop. This is the scenario where the shadow banks, hedge funds and private credit, are forced to liquidate. In this environment, correlations go to 1. Stocks, bonds, and gold all sell off simultaneously as investors scramble for dollars. The nullifier, 20% probability, the 1987 pivot. If any major financial institution fails, and the Federal Reserve immediately cuts rates to 0 or restarts QE within 48 hours, then the deflationary signal is nullified. The mechanism map is short-circuited by the money printer, likely triggering a rapid asset melt-up and a resurgence of inflation. We can now finalize our mechanism map for the last time, capturing the full life cycle of the crash. Stage 1, the setup. Cheap funding, call money, repo, leverage, margin basis trade, asset inflation. Stage 2, the trigger. Rate volatility or collateral scarcity, lender panic, call for cash. Stage 3, the bust. Forced liquidation, price collapse, deflation, insolvency. The lesson of 1929 is that you cannot fix Stage 3 if you ignored Stage 1. The instability is baked in during the boom. The crash is merely the accounting catching up to reality. History is not a prophecy, but it is a pattern recognition engine. The elevator operator in 1929 saw the end of an era because he witnessed the physical toll of a leverage cycle unwinding. Today, we don't see men weeping in elevators. We see lines on a chart and stress in the repo market. But the forces are identical. Gravity acts on financial assets just as it acts on physical objects. When the cost of borrowing exceeds the return on investment, the object must fall. The only variable is how fast and who is standing underneath it when it lands. The crash of 1929 taught us that the economy is not a straight line of progress, but a cycle of expansion and consolidation. Those who respect the cycle survive it. Those who believe this time is different become the liquidity for those who don't. In our next episode, we will explore the sequel to this disaster, the 1931 banking collapse that actually turned the recession into the Great Depression, and analyze the one asset class that survived when everything else went to zero.